Welcome to TheoTrade. This is Don Kaufman. It's June 14th, 2023. Just 12 minutes to go to the cash close here on this Wednesday afternoon. The Fed has spoken. Obviously, we're going to look at that and much more in detail here on this evening's update. Are more rate hikes bullish? Yeah, that's what's on the table right now because the Fed ultimately changed the dot plot, even though today's rate decision was unchanged. The Fed actually changed the dot plot. The dot plot indicates 2 more rate hikes this year. And the reason I say, is that bullish because you need only look at the NASDAQ and recognize the NASDAQ since the Fed announcement is literally unchanged. The NASDAQ right now up about 50 handles, which is kind of a nominal move. But overall, what do you learn by looking at the S&Ps over here? The Fed is having very little negative impact following this announcement. I got to tell you, I am a little surprised. So the Fed, again, they turn around and they pause, which everybody was anticipating. Come on, there was like over 95% probability that the Fed was going to pause. And when I say pause, I mean like, hey, look, no rate hike today. But the market really was not necessarily anticipating 2 more hikes. People kind of thought they'll pause, they'll wait, but they changed that dot plot again, 2 more hikes. And is winter here? Not exactly. Again, look at some of the order flow in products like Nvidia. And the reason I'm bringing this up, and I'm saying like, look, I get that the market's down a little bit, but the S&P is being down 10 points after what? A few 100-point rally is absolutely nothing. And that's why I'm questioning, more rate hikes. Are they bullish over here? Take a look at Nvidia. Nvidia, not only isn't it impeded by the Fed, you would think that the Fed was actually out there buying Nvidia after their announcement. So at this point, the AI craze continues. Look at the volume inside of Nvidia too. I mean, we're looking like average volume here, like 150,000 shares per minute. It's just ridiculous. And again, at what point do you look at this and think, all right, there's eventually going to be some sell side activity? One of the things to be mindful of, especially when you see trade action like this. By the way, look at this coming into the cash close here. It's getting all kinds of crazy. I like it, people. But taking a look at Nvidia, one of the questions that keeps coming up constantly, who is buying all this stock? Let me just make this completely clear to each and every one of you. And one of the things that I really wanted to deliver in this evening's video is you don't necessarily, have to buy stock and hold it like you would think, to cause an underlying like Nvidia to rally. It is the single most important premise of today's market. People think like this old school kind of logic, and that old school logic is somebody's out there buying Nvidia. Are they really buying it right now? The answer is both yes and no. If you take a look at what could actually stage a rally, obviously somebody is eventually buying stock. In the end, what is the market? The market is actually supply and demand marketplace. But all it takes, and again, we all know that somebody sooner or later has to do what? They have to buy stock. So if you look at this, buy stock. If you buy stock, stock market goes up. Newsflash, I think everybody realized that. But what would actually be the genesis of buying stock? Because they actually want to hold it because there's a stock buyback. Push all of that aside for a second. You're a retail client, you rush the marketplace, and what do? You buy calls, and you buy calls in large numbers. Why do you buy calls? Because the buying of calls, if the stock is actually perpetuating to the upside, can make you a couple of bucks. And when you're done buying those calls, you can turn around and sell them, not a big deal. But when you buy calls, who's selling you the calls? The market making firm. So the market making firm, again, is selling calls. And you got to keep this in mind because as soon as they sell calls, it produces what we term negative delta. How do you offset negative delta? By buying stock in positive delta. So you really want to know who's actually buying stock? Who's buying stock is to neutralize their own positions. Yes, it does perpetuate an up move over here. And yes, you can make money off the calls you bought. But in the end, it's actually a net neutral position for the counterparty. And that's one of the things that people miss. And you can actually perpetuate this wild and woolly up move. And you go, well, then how do they unwind the position? Sooner or later, somebody has to sell stock. Why? We have weekly expirations. Okay. If the calls that they're short, right? So they're now short calls. Okay. All right. Short calls. Those calls go what? In the money. And when they go in the money in your short calls, what happens at the end of the week? You get what? There's exercise and assignments. So you get assigned. So what happens when your short calls you get assigned? They actually call the stock away. Well, guess what? They're long the stock. The trade's actually negated at the end of the week. Gotta love it. Okay. Welcome to 2023. We're like, look, this side of the market making business has been going on. Okay. Well, since market making has been going on in options in the 1970s, but it's all, like a little bit of a trade that perpetuates itself much more rapidly, especially when we have weekly expirations. And the weekly expirations are causing these gigantic squeezes to the upside. So when you start looking at stuff like Nvidia, stop with the who's buying stock at this point. You know who's buying stock, okay? It's the market making firms, the proprietary trading firms, anybody trying to hedge. And I'll be honest with you, it's not retail buying calls anymore. Oh no, now it's actually proprietary trading firms, hedge funds. They're rushing the marketplace, buying calls at the ask or above, just like, we'll pay anything for it, because it's actually driving the stocks higher. And you just got to keep that in mind. So don't think per se, somebody's buying stock to hold it, okay? Believe me. Even the market making firms are not thrilled about buying stock that's $426 when Fed fund futures are sitting at 5%, because their cost of carry goes up substantially. With that being said, okay, that is this, again, kind of perpetual trade that you just, you get locked and you start seeing, again, a self-fulfilling, movement to the upside. Eventually it comes to a halt. I mean, look, the same thing, and I always reiterate this, the same thing that actually drives us to the upside can clearly drive us lower. Look at this, Nvidia actually hitting highs coming into the cash close over here. Nevertheless, the S&Ps are going to finish the day slightly lower, but when it comes to the S&Ps, it's all about SPX. I want you to look at the SPX with me right here, right now. Why? You see the line across your screen? In fact, I'm even going to highlight it. That line right there, pivotal. What is it? Okay. 43.64. Where are we trading right now? Basically 43.64. Why is that pivotal? That's the upper edge of the expected move. We hit it on Tuesday, and just take a look at trade. You want dangerous? Oh, you got dangerous. And I'll tell you why this is so dangerous, because you're already sitting at the upper edge of the expected move. So the market, okay, did all it was supposed to do, which is about a $65 move, right? About $65 move to the upside or $65 move to the downside. It did the $65 move by Tuesday. Why this is so dangerous? Because now we're sitting literally at the upper edge of the expected move, okay? The higher probability is, of course, you revert back in. And again, I want to reiterate this. The higher probability of the trade is you revert back into the expected move. And at some point, okay, on Thursday or Friday, you close, if you will, under 43.64. So if you go with just pure probabilities, there's a slightly higher probability that we close inside the expected move. The lower probability, okay, the lower probability, but a very, very dangerous move, is you actually rip outside the expected move. And if you rip outside the expected move, anybody that is short gamma, that is negative gamma, they're actually going to have to hedge. How do they hedge? They buy ES. Okay, so if we start to explode just a hair outside of this expected move, and I do want to show you specifically on intraday trade, you should know these levels. Okay, one of the levels that's absolutely critical in here is right in here. It is 43. Okay, and again, watch it on the chart. It's 43.76. 43.76. You get above 43.76, the marketplace can actually catch fire to the upside. And you can see every time we're in and around this 43.76, there's large spikes, there's huge volume spikes inside of the S&Ps. Keep an eye on it. By the way, that's 43.76. That relates to the SPX, not the S&P futures. The S&P futures are absolutely the hedge. Nevertheless, okay, that level relates expressly to the SPX. All right, looking around the screen, it's also very notable in the QQQ. If we take a look at auto expected moves here, the Qs are absolutely unequivocally outside their expected move. Now we've seen some significant movement, obviously, on the front of tech, okay? But at this point, okay, we have Nvidia. It's Nvidia, and that is the primary break to the upside of the marketplace. Okay, you can't point too many fingers in terms of Microsoft. Microsoft at this point, and by the way, this is worth bringing up on a 5-year chart. Microsoft is incredibly close to an all-time high. Okay, some point in the next few days, you may actually have to consider that 350 level being breached inside of Microsoft. But at this point, okay, as I've said day in and day out, it is a one stock market right now. To the remainder of the week, if we take a look at the SPX, okay, we're going to look at the expected move. All right, we are in fact coming into a holiday weekend. Monday markets are going to be closed. We still have priced in about $42 of movement between now and Friday. However, at the same time, you'll see VIX down, volatility futures down. There's one thing you really want to watch into the remainder of the week. Yeah, I could point fingers towards tech. Of course, you want to watch tech. Watch volatility. And I'll tell you why. Like vol futures, okay, VIX, not often I actually reference the VIX. They are absolutely rock bottom right now. If there's going to be any degree, just any degree of an up move, okay, vol stays relatively flat. But if the market even so much as flinches to the downside, it's going to wear like a badge of honor. Volatility futures will move higher. VIX will have to move higher. You got to keep this in mind. Again, these volatility futures, they got crushed after the FOMC announcement. Okay, if there is again going to be the slightest move lower inside of the S&Ps, you're going to feel it in these vol futures. They simply don't get much lower than they presently are. VIX back down in the 13 handle. All right, if we're going to see anything transpire in this marketplace, VIX rips to the upside. That, people, and that alone is a great signal into the end of this week. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.